I'm going to be talking to you today about using the average as an algorithm and show you how to apply it to pairs trading. You should take three main points out of this presentation. The first point is, what is pairs trading? What is it about? You often hear in the newspaper about quants who use computers to make billions of dollars in the stock market. But the question is, how do they actually do this? The second point that we will be addressing is, how do I create an algorithm that trades pairs? Hopefully by the end of this presentation, you'll have a clear understanding of how you will do a pairs trading algorithm. And the final question that we'll be addressing is, what are the returns from this strategy? Has it increased? Has it decreased? When was it profitable? Is it still profitable? So what's the motivation? Being an economist, I obviously have biases. And my bias is people are motivated by money. Or at the very least, it's very easy to explain people's motivations by money. So what we want to do is we want to make money consistently from the financial markets. I don't want to go out tomorrow and say, well, okay, you could lose $1 million or make $1 million. I want to consistently make a small profit. So the question is, how do we do this? The answer that economics provides for us is that we give information. Here's a bit of a background to help you understand why it is that we can sit all day on our computers at fictional numbers and make money. Financial markets are what economists term informationally efficient. That is, they provide a mechanism to link those who are willing to supply information from those who are willing to pay for it. And this is a really important fact that I'd like to dwell on for a bit. When I buy a financial instrument, I'm really buying a promise. That promise says that conditional on some outcomes, I will get a return. For me, I really need to be confident that that financial product will pay out that return under those conditions. And therefore, I'll pay a lot of money to get information on A, whether those conditions will happen, and B, what is my payout under those conditions. So really, the financial markets are just a place where people get together and meet and trade that information between those people looking for it and those people willing to provide it. In order for us to receive a payoff from the market, we need to provide better information that is currently being supplied. Because if I were to go out and say it's 20 degrees Celsius outside to the market participant could just go on Google and look it up and find out that it's 20 degrees outside. So the extra value that my contribution gives is very small, and it's very limited. Therefore, I will not get an extra return. So really, I have to provide something extra, a little bit more information, something that that investor cannot get elsewhere. So in this sense, financial markets are also economically efficient, because we have to work in order to receive returns. I'm not going to get into the efficient market hypothesis. Hopefully that will be a discussion of a future video. But for now, just take this. So what's the strategy that we'll be focusing on? We will be focusing on algorithmic or rule-based trading. The reason for this is that this is the only way to consistently generate risk-free returns, and that is arbitrage. Now I want to be very clear about this. What I'm not saying is that someone like Warren Buffett cannot make consistently money. What I am saying is that someone like Warren Buffett cannot make risk-free money. And also that someone like Warren Buffett cannot teach other people exactly how he makes money, because a lot of it depends on the contextual experience that he has. These strategies differ from other fundamental technical analysis, such as those by Warren Buffett, because they're context specific and they're not scalable over different traders, different markets, and different asset classes. Rule-based trading is literally take this rule and implement it. And when you see how I discuss it, you'll understand that it can actually be very simple. And that is why it is inherently a different way of trading than fundamental or technical analysis. What are the steps to algorithmic trading? The first thing we need to do is create an idea. Because if you remember from our previous slide told us, well, we have to create something that the market doesn't have. So it has to be a new, coherent idea. The second thing is we have to take our idea and convert it to an implementable algorithm. It's great that I have an idea, but I have to actually be able to implement it into a coherent, effective trading strategy. The third step is we have to test that algorithm to see under what conditions it's profitable. So even if I have an idea and I implement it, I still have to see, well, does the market return for this information? If my information isn't valuable, then the whole point is moot. The fourth step is to actually deploy the algorithm. The fifth step will be to monitor the algorithm to make sure it doesn't blow up, it orders when you want it to. And the sixth step is to relax and just know that your algorithm will be safe and steady and working. And it will be working for you. That's the whole point of rules-based trading, is that you don't actually have to think. You do your thought process, you do your research, you do your due diligence, you monitor it, but otherwise there's no actual human or active involvement in the decision making. I will be focusing on the first three steps. I do not have a computer science background, and so steps 4, 5, and 6 are not my strengths in my background. Hopefully in the future someone else can contribute and help you understand steps 4, 5, and 6. So now we're going to talk about step number 1, which is creating an idea. Our idea is about pairs trading. You've heard a lot about this in the market, but unfortunately I have yet to see a coherent, good explanation as to what pairs trading is from a news outlet or media source. Pairs trading ultimately is that when two instruments have a correlation that is determined by fundamentals, so this could be cash flow, underlying assets, risk exposure, there's simply a lot of market variation, and this can temporarily dislocate the price of these two instruments from their fundamental long-term relationship. So pairs trading is, in a nutshell, is we should bet that prices will return to their fundamental correlation. So I provided with you with a very nice diagram to understand exactly how this works. So as you can see here, the price is fluctuating around some long-term fundamental, which is the black line, and the price is the blue line. When the price is above the fundamentals, then you sell to bring it down. When the price is below the fundamentals, then you buy. It's really that simple. This is the strategy that those people made billions of dollars off of. And in the future, we'll see why it is that we can't make money. So first we're going to talk about the mean as an algorithm. Now when I say mean refers to this is the statistical name. It refers to specifically the algorithm that we use to find out the average. It's a measure of central tendency. So the mean tells us, where is my information clustering? Where are these specific points clustering? Where are they mostly together? Because it's hard to describe the entire distribution. We just want one number that helps us encapsulate and compare. So algorithmically, the mean is this. Note that the mean is really not an average, and this is one point that I'd like to dwell on for a moment, is when you say mean, you're referring to the specific algorithm of minimizing the sum of the distances. The mean does not mean average. When people say on average, they mean it's most likely that. The only points when a mean and the average are the same is in a normal distribution. However, most things, especially those in social sciences and biological sciences, are not normally distributed. In fact, they're often unnormally distributed, and those distributions can change both over time and different categories. So it's really important to understand that the mean is not the average. So how do we create the mean algorithm? Well, if we have big X, which is equal to a collection of little x's, or if you will, we have this set that is X and it has all these little prices, we need to find the X bar that makes all the differences between that X bar and all our little x's 0. Now this is a really profound point, and in graduate school they never taught us this. Is the average is the parameter that makes all the residuals 0. That's it. It's the number that when you put it in a group of numbers, it cancels out. So it just so happens that that number is what we do the average. So you just collect all the little x's and divide them over the number of little x's there is. And that's X bar, which is the average, or the mean. Now we're going to talk about the data, which you can fully download from my website, and I will have a link up there that will show you exactly where that data is. So I took Lowe's and Home Depot New York Stock Exchange daily closing stock prices. Now, one might ask, why did I choose Lowe's and Home Depot? Because I happen to know that this used to be a very profitable strategy for many hedge funds in the past. And so, knowing that, and to illustrate, because this is strictly for academic purposes, the point of this presentation is not to show you exactly how to make money. Because let's be honest, if I had a strategy that made me $1 million a day, why on earth would I be putting it on YouTube? So this information is from September 1981 to September 2011. So we have a bit more than 8,000 prices per stock. The percentage return, or simple returns, was calculated for each trading day. So basically what you would do is you would take the current trading price, subtract the previous trading price, and divide it by the previous trading price to get the daily return. One thing I would like to address is the difference between simple and logarithmic returns. Personally, I prefer simple returns because they're much easier to understand. On a daily basis, the differences between them and logarithmic returns is very small, and they require less computational error. However, if you use logarithmic returns, you can do the exact same analysis and you'll find the results are quite comparable. What this mathematical transformation does is it allows us easily to compare across periods, because what we're doing is we're first differencing. We're taking the change in the same price over time. But since it's the exact same price, the effective time turns into a concrete unit that we can measure. I'm not going to go into the complete mathematical proofs as why this transformation is good, but take it as given that this is a very useful transformation for doing research on trading strategies. It makes analyzing the data easy. Why? Because any price difference between two periods in time is just the sum of the interperiod returns. So if you can imagine, I have all these returns laid out before me. If I want to know how profitable I am from point A to point B, I just add up the returns from point A to point B. That's it. That shows me the pure net profit that I made from that trade. Obviously, this excludes transaction costs, trading costs, human errors, but we're not going to be going into that because we're strictly referring to whether this strategy is profitable or not. So here's the results. I made these charts using R, and all the R code is at the end of this presentation, and you're more than welcome to run it and analyze it as you will. As you can see here, I have the daily returns for Home Depot and Lowe's. The blue line corresponds to the average return, which is 0%. So this is a really important point. If you choose unconditionally, as they say, or if you just randomly chose a day, you would not make money investing in Lowe's or Home Depot. This is often a reason why researchers propose the efficient market hypothesis as effective. Because if you just averagely choose a day, you will not make money. Another thing I want to point out is how messy these distributions are. So if you see all these little dots, they correspond to returns and data points. Lowe's, as you can see, is actually much more noisy than Home Depot is here, because you can see there's a lot more dots around the lower and upper portions, as opposed to Home Depot, which seems fairly consistent. Another thing to note is that this is very much a frequent characteristic of equities, is that there's all these low data points here. This is very much due to the fact that equities are known to be asymmetric in their daily returns. They do well most of the time, but in bad times they fall quite a bit. If we want to look at the total returns, or just the price change over our period, you can see that there's been a sharp appreciation. However, one thing to note is that after about trading day 3000, most of the gain for both Home Depot and Lowe's is pretty much gone. As you can see, it's fairly flat here, and it's very flat here. That trading day happens to correspond with about 2004-2005, when US had the peak of the housing boom. Afterwards, all that growth, so 2006-2007, were already built into the stock price, so the market wasn't reacting very accordingly. Another thing to note is that the reason why Home Depot accelerates quite a bit faster than Lowe's is because Home Depot IPO'd much later than Lowe's did, about 5 years later. So that's why. So let's do some analysis on our returns just to help us understand what picture we're looking at. So as I said earlier, the mean returns were 50% and 40% for Home Depot and Lowe's respectively. Every year, if you just took a year and you rolled it, you would get an average return of about 50% for Lowe's and 40% for Home Depot going forward. Most of that price appreciation, as I mentioned earlier, ceased after the 2004 to 2005 period. Our daily returns do cluster around the mean, and this is one very important point that I'd like to address. If we can just go back here, you'll see that most of the time the returns, they cluster around that blue line, which is the mean or the average. So that's most of the time, but in times of stress they start to deviate. So you can see here there's clustering, and then all of a sudden in this period you get a deviation, and then clustering again, and then deviation. It's a very important point. Another important point is that there are large deviations from the mean for certain periods in time. This means there are certain periods where you, as an investor, can make a lot of money. Periods of abnormally high returns are also followed by periods of abnormally low returns. So if you're willing to come with me for a second and see here, you see that the periods here for Lowe's, let's say, periods where there's a lot of clustering at the top are also periods where there's a lot of clustering at the bottom. And that's a really profound point. If the daily return for Lowe's is above 0 and the daily return for Home Depot is below 0, then you buy Home Depot and you sell Lowe's. So simply, if you remember going backwards, that our unconditional average return was 0, that means that we could infer that anytime it's above 0, it is deviating from its long-term fundamental. Anytime it's below 0, it's also deviating. So what we can do is we can say, well, if there's this current relationship between these stock prices, maybe we can make money doing that. Conversely, if the daily return for Lowe's is smaller than 0 and the daily returns for Home Depot is larger than 0, you buy Lowe's and you sell Home Depot. The important thing to consider about this strategy on a fundamental way is that this bet, this argument, this algorithm is saying that all shocks that happen to both Lowe's and Home Depot are systemic. If one thing happens to one and not to another, we'll cancel that out as noise and we'll trade against that action. What we don't trade against is things that happen both to Lowe's and to Home Depot, because we know on average the returns are going to be 0. So we can't make money just betting on their direction, but maybe together, if they deviate, we can make money. Since we first difference the data, we can simply add or subtract the daily returns and simulate gains from buying and selling. This is actually very easy, and I highly encourage you to do this in Excel, because this way you can intuitively get an idea of when I bought and when I sold and how I made money. So this is the returns to that kind of strategy. As you can see here, there's a lot of noise. So there's a lot of periods when you make money, and there's also a lot of periods where you don't make any money, because all these little dots here just mean 0 daily returns. So you did not engage in your strategy. Another thing to note is that the strategy starts to go down. So around the 4,000 to 5,000 day mark, you're not making much money. So if we look at a yearly rolling window of this strategy, you can see that your average yearly return goes down precipitously in just one straight line. And that's really shocking. Think about it. There's just a huge drop in the profitability of this strategy. And one can attribute that to competition. Other people hear about this and they enter the strategy and they wipe out those gains. If we look at the monthly rolling window, and the reason why I include monthly and weekly rolling windows is because it often helps you understand how the strategy changes with different distributions. So if you look at the monthly rolling window and the weekly rolling window, you see that what happens is that it's mostly in that upper fuzzy region. So these upper shocks right here, this upper shock, that upper shock, and here it's very easy to see. These upper shocks pretty much disappear as you go forward. So in fact, it's the upward potential of this strategy, which disappears over time. Just to recap, the returns to this strategy decline significantly over time. It has been unprofitable for about 4.5 years. There's a substantial number of days when you trade where there's just no daily returns. The greatest reduction in profitability corresponds where the mean daily return for that week is above 2%. Now, just to give you an idea, above 2% mean daily return for a week. That means that's 14% per week. 14% of your capital per week. So just a back of the envelope calculation, if you put $1 million, what's 14%? $140,000. And that's just from $1 million. That's an incredible amount of money for what is really a simple strategy.